This Wednesday, we will get the highly anticipated rate cut from the Fed in response to the massive weakening in the labor market. I say massive now because on Thursday of last week, we finally saw initial jobless claims spike up and over 250,000, which is huge. The question is though, are markets poised to crash and burn on the cut, or do the markets look healthy here and supportive of the bull run continuing? Like we said last week, remember that only price pays, not what you think should happen. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar with very minimal upper and lower wicks, not much to read into there, and instead a very strong close from the buyers towards the highs of the weekly range. This is bullish. If we're thinking about location on the bar-to-bar count, clearly a higher low as well as a higher high. And the most important component is the candle close completely outside of and above the previous week's range. Buyers go 2 for 2 on the bar-to-bar count here. If we're thinking about the overall trend, obviously this is a brand new all-time high close, which means that it's a brand new higher high in the trend count. And although there is no indication of a pullback looking imminent, it's certainly possible that if something were to develop, we could afford a weekly higher low and the trend would not change. I'm still going to maintain the stance that this previous all-time high could still act as a weekly higher low. And of course, there will be a daily downtrend to get from point A to point B. There will be short trades to take if that were to unfold. But I would also start thinking about this level right around in here in terms of a weekly higher low. It's this previous resistance which has already acted as support on daily and hourly charts in here, and it's closer to about 637. If the daily trend flips to down and we find buyers here on the weekly timescale, it would still qualify as a weekly higher low. You'll notice that if we do something like this and just throw back on the previous all-time high, we have the weekly 20 SMA acting as confluence with that level. Do we have anything here at this level around 637? The answer is actually yes. If we come in here with the anchored view apps on the weekly, what you'll notice is that the breakout anchored view app, as well as this pullback anchored view app, is right around that zone. So it doesn't have to be clean, it doesn't have to be to the penny, but the point to illustrate here is that the weekly trend is up, buyers are clearly in control, and there are plenty of reference points that could cleanly act as a higher low and preserve the trend in the upward direction. We can also come in here with a Fibonacci from this low up to the new all-time high. And what you'll notice is that this new level that we're focusing on is well above the Fib 38.2. So there's no issue from a Fibonacci perspective. This would classify as bull flag consolidation on the weekly timescale. Obviously, if we come in from the low here up to the brand new all-time high, the higher the market goes, the more likely it is that over time, the Fib 38.2 starts to align with this previous all-time high. We're not there yet, but again, the higher the market goes, the better confluence you'll get at that reference point. Let's take that off and let's take a look at our volume profile here on the weekly, just pointing out that there are some high volume nodes. If we just extrapolate this out right towards that level, again, 637 high volume node in here. You could also bring this one out. It's slightly underneath. Again, it does not have to be perfect, but something in that zone does offer a weekly higher low over reference points that would make sense. Of course, the concession is if we break down beyond that, it's very likely that a low volume rotation easily brings us back closer to the previous all-time highs sooner rather than later. So on the weekly timescale, the bottom line is that buyers are in control here, and even if the market pulls back, although there's no sign of it, there's nothing really that would make me change my tone in terms of the trend. Let's drop this down to the daily timescale and let's see what's happening from this perspective, firstly evaluating this week's expected move. If you're not familiar with the expected move, it's this gray box right here, and you can check out the video tutorial in the top right-hand corner on how to set this one up. If we're contained by the upper bound, the number is 667.47, and that would imply a higher high in the trend count and a brand new all-time high. If we're contained by the lower bound, the number is at 647.35, and that would certainly constitute a daily higher low relative to this pivot from back over here. The weekly expected move is bullish from my perspective. If we're thinking about the daily trend, obviously the trend is up. If this was a low, I've been saying that we'll give the bears the benefit of the doubt. We'll call it an equal low. If you want to split hairs with me, technically it is a higher low, but clearly this highest high now means that undoubtedly, even if that's an equal low down here, we are in an uptrend. These are brand new all-time highs, and there's plenty of room on the daily chart as well to pull back and offer a daily higher low. If we're thinking about key reference points, I would certainly look to this previous all-time high at 652.25. If the market's going to come in a little bit and support around this level, is that a place where buyers could step up and achieve a daily high or low? The answer is absolutely, and it would make sense using previous resistance as newfound support. You'll see that we started to do something close to that into the end of day on that Wednesday session when there was a bid after the gap fill reversal. What do we have underneath that? Is it possible that we could even pull back to these lows, the lower edge of the weekly expected move, and get a daily higher low around that 647 spot? Absolutely. If we were to pull back to here, let's say that we do something that looks like this, we'll talk about it on the hourly in a moment, and by the time we get there, we have confluence with the daily 20. What an awesome spot, and confluence with the lower edge of the weekly expected move. What a great spot for a potential higher low. Now, I will caveat this by saying this is a very poor and mechanical level, right? You should not really see a market test back-to-back lows like that and call it a secure low. There's no excess on that low. So if the market on the daily time scale is going to come down and test this level, what I personally would like to see is an overshoot of the level that then comes back above, and now we have, okay, here's a low, here's an excess low that repairs this structure, and now we can move on with the daily trend in the upward direction. If we're underneath that 647 spot in here, is it the end of the world? Am I going to start running for the hills and saying, oh my God, the market's going to crash and burn? Well, number one, no, because of what we just talked about on the weekly time scale, but I would be slightly concerned if the market was getting acceptance in this zone here. I would probably start to become more concerned if this level as a line in the sand at 642.50 starts to break down, noting at that point, now you have this previous range here, this previous range here, and everything since the low that was produced on this session, the beginning of September, basically via the gap down, that was that Tuesday from the shortened holiday week. All of this is overhead supply, and I would start thinking about, okay, is it possible that you have left? Is it possible that you have head? If you start breaking down underneath this level, obviously the neckline would be way down here, but you're certainly putting pressure into the market trying to build out some sort of right shoulder structure. Now, let's just pause for a second and think about this rationally. What did we say in the intro, right? Only price pays. Does it appear as though the market is attempting right here, right now, as of the close on Friday, to put in bearish consolidation underneath 642.50, or does it appear as though the market is trying to rally with momentum in the upward direction? I would certainly say the latter. So let's take that off the screen, let's get away from the bearish bias, and let's start thinking about the chart in front of us. There's absolutely an upper wick here that looks over the Thursday high and fails back into the range from Thursday. That's Friday's close. So is it possible that a pullback could develop early in the week? I think the answer is yes, right? And we'll see more evidence for this as we move on. But once again, the primary case to make is that even if we pull back, so say we take out Friday's low, the inverted hammer low, we rejected the new all-time high, that's fine. If we pull back, my first thought is, do buyers step up here? I want to be looking for that possible long. If we move beyond that, once again, we talked about this thesis. I want to be looking for the long here to then navigate back up to the all-time high. I do not want to prematurely jump the gun on the bear side until the daily trend looks like it's actively starting to shift in the downward direction. And as of right now, we just simply do not have that on the daily look. If we come in here with a Fibonacci, because I don't want to do it on the hourly, but we'll do it here on the daily, doing something that looks like this, what you'll notice is the Fib 61.8 is very closely aligned with that 642.50 level. And if you've studied Fibonacci's, you know that this is the line in the sand, right? The more time you spend underneath the Fib 68.1, the more likely it is that you get the full 100% retracement. So as long as we're over this level, I think that we're doing okay in terms of maintaining the daily uptrend. There's not great confluence with our Fib 38.2. It's technically at the 2-day high in here, closer to that 649.50-ish spot. However, what I think we'll see on the hourly chart is that there's a much better sort of confluence out of the Fibonacci's, okay? So coming in here, what we'll see on the hourly, first let's just start with our basics, right? What is the trend? Obviously it's up. You have lows, higher lows, higher lows, higher lows, higher lows. This is the highest high in the hourly trend count, just like it's the highest high in the weekly trend count, the daily trend count. Here we are on the hourly. If we were to pull back, is it possible that the hourly chart could afford a higher low? The answer is of course, right? So breaking down underneath, Friday's low at 657 can open the door for a thin structure retracement, and this would be the first spot to look for that potential long. Once again, does this make sense? I think the answer is absolutely, noting that it is the previous all-time high and this inflection point from that Wednesday session and where we rallied to close. That's 652.25. So hypothetically, what could a trade situation look like? We consolidate, we Brigade bolt underneath. If you want to try to trade shorts from, let's say, point A to point B, be my guest. But I would instead say that the better trade outcome to be looking for is the pullback long off of 652.25, trying to navigate back to the all-time high at 658.50. That's situation number one. Obviously, situation number two would just be straight up continuation. Now, this is situation two because of the structure that we just evaluated on the daily and the lack of acceptance at the all-time high here on Friday. If we do something that looks like this, then we'll just go in the direction of the trend. That's fine. Blue sky breakout, right? That's over 658.50. The upside takes care of itself. Where things on the hourly chart start to get a little bit dicier are if we get a little bit of that deeper daily pullback, right? Say we get a bear flag down here and we actually Brigade bolt underneath 652.25, that's when we can start to navigate towards this 647.50 spot in the lower edge of the weekly expected move, the daily 20, the whole 9 yards that we were just talking about. So if the market were to make it here, that's also a spot where I'd be saying, okay, do buyers step up and is there a trend reversal? If you're not comfortable taking this long here off of, let's just say, hypothetically, an inverted head and shoulders, the next long would be the recovery back over this previous pivot high at 652.25 on an hourly higher low. Right, so that's how I would look to trade this on pullbacks. Once again, if we were to find acceptance underneath the lower edge of the weekly expected move, I would start to become a little bit more concerned about the market. A question that would be raised, of course, would be, okay, buyers, you had a momentum breakout here. Why are we failing the daily 20? Why are we not producing the ideal daily higher low over this level, right? So that to me is certainly cause for concern, but we're just not there yet. We can't speculate on this happening until it actually happens. We can prepare with a back pocket situation, but it's not the current look of the chart we have in front of us. Let's come in here with the special fib from, first of all, here to here, just pointing out that the fib 38.2 is perfectly aligned with that Friday low. Thus, in my opinion, if we take it out, we're failing the high-end type bull flag consolidation. I think the pullback is reasonable, once again, from a point A to a point B. I'm not against trying to take that short. You do have thin structure through the rally on the Thursday session. This was a little bit of a short squeeze, maybe some new money buying. We'll look at the market internals in just a second, but the market profile is absolutely a P-shaped profile. If we go beyond that, let's come in here with a fib from the low up to this high. What you'll notice is the fib 61.8 is very closely aligned with, so this is last week's range basically, right? It's aligned with that key level at 652.25 where we're looking for buyers to step up anyways. So in my view, this is a reasonable little short to unfold. When and if we get here, the top priority will be evaluating, do we have buyers stepping up? Now, this is the approach we should take ahead of Wednesday at 2 p.m. That's when the FOMC meeting is. I would say that sort of anything can go on a catalyst, right? The underpinnings of the market will look more bullish than they do look bearish, and we'll see that as we go through today's video. But as of right now, this analysis stands ahead of Wednesday at 2 p.m. At 2 p.m., anything goes on the press conference, and specifically the updated SCP coming from the Fed at, again, the meeting. So let's clear that up. Let's finalize with our anchored VWAPs on the intraday and see what we have here. Notice how the cluster of VWAPs off of the low here are confluence with our line in the sand, sort of ideal daily higher low, daily 20 SMA, around that 647.50. You'll notice that this gap up from the labor report, which faded, of course, very hard, is confluence early in the week with 652.25. Notice how this, from the gap up on Wednesday, will slightly align with, over time, depending on where we open on Monday, that 657 spot. So I really like what's happening here with the anchored VWAPs. They're not random right now. They're actually reinforcing many of the levels that we've been watching and talking about in today's episode thus far. Let's take a look at our market profile. If you're not familiar with the profile, check out the video tutorial in the top right-hand corner. What do we see here in terms of the actual exchange level data? Was Friday bullish? Was Thursday bullish? I think let's start with Thursday because it was that straight up session, right? On Thursday, absolutely strong volume inflows, huge cumulative build out of the tick. Most notably, it was not a straight up and then flat into the close. The fact that this was a subtle 45-degree line means that consistently through the session, there was buying at the exchange level, even as the market balanced off into the close. So I'm a little hesitant to call it just straight up short squeeze to the upside. It does seem as though new money buyers were getting involved there. You can see the advanced decline line was certainly in trend higher zone, and the index score was nice and strong as well. Now, on that Friday follow-up session is where we can read into this and say, okay, is it possible that as we were trying to make a brand new high, is it possible that that failure is worth reading into? Because remember, we closed back down inside of Thursday's range. I think the answer is yes. In terms of volume flows, we actually had outflows from the market here. You could see the advanced decline line was negative. It was not in trend lower zone, but it was negative. The index score was very, very lackluster towards the zero line, and the cumulative build was actually negative as well. So I don't think we have new money sellers stepping up. I certainly would not look at this and say, oh my goodness, the market's going to crash and burn, but I would think it's reasonable to retrace some of this thin structure that we have from the Thursday straight up rally. If we take this out, we're going to be left with a little bit of overhead supply, and once again, this pullback seems totally reasonable into the early stages of this week. What about the market profile? Is this going to help us or hurt us in terms of this analysis? What we'll find is it's actually quite helpful in terms of supporting this thesis that we've set forth so far. If you're not familiar with the market profile, check out the video tutorial in the top right hand corner. What do we see here? Certainly on the Thursday session, value and point of control did migrate higher. You'll notice that we do have an M period excess high, plenty of A period in the excess low, so all set there. But look at the Friday session and notice how value is completely contained within the value area from Thursday. If we were going to expect a bullish advance here, you probably would have wanted to see value overlapping to up with that Thursday session, and it just wasn't the case. A more nuanced perspective might be that the point of control was actually left lower in the session on Friday rather than higher as we attempted to make a brand new high. If we zoom into this, we do technically have a decent excess high in K period, so all set in terms of references. It's not like we have a poor high that's in need of repair. So what I'm really keying into is primarily just the fact, from profile at least, that the value is unchanged. Value is overlapping, and inside in terms of overlap. It's not overlapping to up. It did not get clean and break away to the upside. Very, very balanced here at the high, showing a little bit of reluctancy from the buyers to continue the momentum in the upward direction ahead of the Fed. Now, if we're just examining the P post of the Thursday session, there's like hardly volume at price through this entire thing. So it doesn't mean the market's going to crash and burn, but it should in theory be an easier rotation to the downside rather than a more difficult one where we're having to battle through a huge chunk of value where a ton of positions are held from. Let's get back on over to the platform here and let's get on over to our good friend, the nasty NASDAQ on the weekly time scale. What do we have from the QQQ? Let's just clean up this chart a little bit. A couple things I can do for us. Let's get rid of those corporate actions and let's throw on our 20, 50, and 200 SMA. So in terms of candle structure and location, very similar finally to the S&P 500. In terms of the divergence we've been seeing over the last couple of weeks, we know that the NASDAQ has been lagging behind. We had a couple of red-bodied bars in here when the S&P was more so an elevated up move. But as of now, we have, similarly, a solid green-bodied bar, very minimal upper and lower wick, strong close from the buyers towards the highs of the range. That checks out. In terms of location, bar-to-bar count, clearly a higher low as well as a higher high and a close, completely outside of and above prior week's range. 2 for 2 on the weekly count, brand new all-time high, finally, which allows this a lot of the same opportunities as the S&P 500 primarily. Now, what I wouldn't really want to see here is if this is a balance range on the weekly, what I want to avoid on the NASDAQ is actually a look above and fail. If we find ourselves back down inside of this box, I would hypothetically think, the target should be the bottom end of the range. When you get look above and fail, you really should rotate to the opposing end of balance. So that would be in here, much closer to let's get the level at 553s, right? That would be the low of this red bar from back here. Now, the question just becomes, is that still a weekly higher low in the trend count? And I think the answer is yes, right? We never actually flipped into a daily downtrend, although we were very close with the head and shoulders that was taking place here. We never broke the neckline, right? So it's still possible to flip into a daily downtrend and achieve a weekly higher low from this perspective. I would still use the prior all-time high around that 540. You're noticing that you're going to get your daily, sorry, not daily, but rather weekly 20 SMA confluence with that. It would be a breakdown underneath that original neckline. So let's take it one step at a time. On the weekly time scale, again, the primary thing to avoid if we want to remain bullish here is a look above and fail. We really don't want to see something that looks like that. And therefore, on the chart here, you're probably looking at something like 578 maintaining itself as a key level of support. We'll see 579 as we get closer to the daily time scale. Let's come in here with the anchored view apps on the weekly. Notice that this is inside of that range we were just talking about, the two anchors from both the pullback as well as the breakout over here, which would just mean that maybe it's not the best short inside of this range, which kind of aligns with the higher time frame trend weekly still being in the upward direction. Even if we get sort of this look above and fail outcome, right, it might not be an easy short, noting that you have some of this congestion inside of that range. The better short, so to speak, could be underneath the bottom of this bar, which would be breaking both of these view apps as well as the gap up view app from the May deal to make a deal with China when it came to trade wars, right? So that is sort of our key reference point to the downside. That would be closer to about 550, right? Let's come in here with with the Fibonacci's just to see if we're getting any confluence from this point of view, doing something along these lines. Would you look at that? 38.2 is roughly the bottom end of the balance range here. So even if we do get look above and fail, I would still classify it as bull flag consolidation when measuring from point A up here to point B, the brand new all-time high. Are we getting confluence finally out of the Fib 38.2? Not quite. Again, what we're looking for is when these things align for parity, we will start making note of that. And if a larger downdraft occurs in the market, sometimes it's funny how these things work. Sometimes it's perfect how they line up, right? It just takes a little bit of going sideways, digesting, maybe a little bit higher of a pop, and then a pullback because we got that higher high. And again, it's like I'm not positioning based on this very, very speculative forecast now. It's just funny the way the market works sometimes, right? If this ends up being the case, wouldn't that be something? Anyways, let's stop talking in terms of speculation there and let's continue to look through our data points that are more concrete and in front of us on the charts right here, right now. What do we have in terms of this high volume node? It's kind of the top end of that balance range. Once again, if we could stay over the range high, which is closer to, based on volume, I mean, we're talking about 577. The technical level is a little bit higher than that. We'll see it in a moment. But if we're above that, no issues here on the weekly time scale. If we get underneath it, I would still think, yeah, look at that. Look at the bottom end of this high volume node. It's right at the low of what I would consider the gatekeeper for a breakdown of the balance range in here. Everything aligns kind of with these volume studies, Fibonacci's, and anchored view apps that we've just been looking through. Let's take a look at the daily time scale. Let's evaluate the weekly expected move, the whole 9 yards, everything we typically do. What do we see here? In terms of expected move, you are getting very similarly to the S&P 500, a higher high, that's 597.89, and a higher low here at 575.43. So bullish on the expected move. You can clearly see that we finally got a breakout over the top end of the range. And what I would really want us to focus on here on the NASDAQ is actually the double bottom neckline. Okay, so you have low, you have equal low, and then you have a neckline. As long as we're above that neckline on the daily time scale at 576.50, this is going to potentially qualify as a very clean daily higher low. Right, from here to here, clean higher low, lower edge of the weekly expected move, daily 20 SMA, it all makes sense. Neckline of the double bottom, that level, huge confluence. So if the chart is to pull back on the daily from the highest high in the trend count, looks pretty solid there at 576.50 for a potential hold. Now, let's do a little bit of sort of dissection here. Does this candle look as bearish as the S&P 500? To me, the answer is absolutely not. Notice that we did not close back inside of Thursday's range. As a matter of fact, we went gap fill reversal and closed at a brand new all-time high. So could it just be a little bit of catch-up between the NASDAQ and the S&P? It's possible, but I would look at this chart and be much more confident and bullish based on the close of that Friday session. So I think a base case here, instead of a pullback being the first thought, might just be straight-up continuation. If we get acceptance over the all-time high, blue sky territories should take care of themselves. If we start to break underneath Friday's low, it's possible you get a little bit of a pullback towards this level here. You'll see why that gap up open is not as relevant, but that would be at 581.25. If we move deeper than that, that is where that big daily level we just talked about. So let's say we get something that looks like this. This is where I would still be open-minded to a daily higher low over the neckline and all that confluence that we were just mentioning at 576.50. Where I would, of course, then change my tone on the daily chart would be if we start to get price acceptance underneath that level. If we start to see something that looks like this, okay, question mark. First of all, we're getting that weekly look above and fail. Target should probably be the bottom end of the range. If we do go to the bottom end of the range, do we get a bounce for a lower high? Any equal low reattempt? Okay, now the door is open for a larger trend reversal. Just like we talked about in the S&P 500, let's hit the pause button for a second. Are we dealing with this situation right now? Right? I always love to snap us back to reality. We can speculate about this and we can get all fired up in our heads about this big, massive trend reversal and it's going to look like this. There's going to be a lower high. We're going to crack this neckline. We can get all fired up about that. But for what? Where is price action right now? It's right here. Let's go step by step, level by level. In the intro, only price pays. So if price is over 581.25, I'm very bullish on the daily timescale early next week. If we're in blue sky territories, I'm very bullish on the daily timescale early next week. If we pull back into 576.50, I might hypothetically add to my long-term portfolio on a daily higher low attempt at 576.50. Are these things that are much more reasonable and sound thinking given the chart structure in front of us? I think so. So with that, let's do a couple of measurements here. Let's take the fib from the daily low up to the new high. Again, just it's look at how beautiful that is. Fib 38.2 right at the level. Perfect confluence, just meaning that I would really start to put a lot of emphasis and trust into this level here should we pull back. And key, find buyers intraday. We're not just layering limit orders in there. We want to actually see the response from the buyers. Let's take a look at the hourly time scale. Let's get a little bit more granular. Very, very clean chart here. Again, look at the fact that how on Friday, we didn't just consolidate after a quick look above and come back into that Thursday range. We actually got follow through in the upward direction. So therefore, if we do pull back, any congestion in here is cleanly an hourly high or low. If you support this zone, I wouldn't say it's like the end of the, it's not the make or break zone, but if you do support here on the hourly and find buyers and get continuation, don't be shocked, right? It's not a make or break, but don't be shocked if it happens. If we move through that, maybe you could try a lower high under the zone for a short from point A to point B. There's not a lot in terms of structure through that lower wick, but at point B, what are we doing? We're reevaluating. We're saying, is it possible that a daily high or low shows up? Once again, something that looks like this. From here, we can reassess for this, and then of course this into blue sky territories, level by level, step by step. If we get underneath that 581.25, this is where I'd be a little cautious of being a short, right? By that point, I don't want to say the move has unfolded, but let's play a little game with speculation. If the chart looks like this, and you get two large hourly bars, the first two candles of Monday, immediately lower in here, would I start chasing shorts on this low into this consolidation and congestion from back here? My personal answer to that question is no, just because I know what's sitting here. I don't want to be short late to the party, shorting into support, only to have this thing blow up in my face and rip back in the upward direction. I mean, how many times has this happened over the last couple of weeks? If you started to get aggressively short into these lows, ripped right in your face. If you started to get aggressively short into these lows on the labor report, ripped right into your face, right? So in my view, it does not really make a whole heck of a lot of sense right now to be a major short into this zone until the daily trend changes, right? And I'll stand by that. Like when the daily trend changes to down, everybody's like, oh, you're so bullish all the time, whatever. It's like, has the daily trend ever flipped to down? Well, it did back in, late February, early March. Go back and watch the videos there. Were we bearish because there was a daily downtrend? Absolutely. So when the price action confirms that we do have a reversal in trend, guess what? We will become bearish. I was prepared. If we broke through this low, I was prepared to be bearish on the market. It's just it never happened. It never actually took place. The daily 50 supported price and we're higher. So I think let's trade the chart in front of us. I think that the S&P looks a little bit more susceptible to a pullback than the NASDAQ. But even if both indices pull back, there are plenty of spots that could maintain higher lows. And that'll be our primary base case here. Let's come in here with a Fibonacci just to be congruent with everything that we've done over on the S&P. We'll take the weekly fib coming from here. Let's get a click. There we go. Up to this high. Fib 38.2 and 61.8. Again, perfect. Can't sort of make this stuff up. The math is the math. There you have it. Reinforcing both of those levels. Let's come in here with our anchored view apps on the intraday. And what we'll see is a lot of confluence right around the same spots. Right here, and then over time, these two right here, at least early in the week. Anchored view app from the low back from multiple weeks ago now, 2-3 weeks ago. All right, that is what we have on the NASDAQ. Let's check in on the market internals for the NASDAQ side. What do we have? Same story as the S&P 500. Really strong on that Thursday session. Really strong here, 45-degree line, not straight and then flat. And then on Friday, right, as the market is grinding to new highs, I think this is noteworthy. The volume flows were meager. If we look at the advanced decline line, we have negative territory, and we actually have a bearish build on the cumulative. So, aside from price action itself, the underpinnings of the NASDAQ on Friday really weren't all that strong. A lot of your culprit there is going to be Apple and, of course, the Tesla move that happened on Friday, fueling the gain in the NQ, where some of the other components weren't really playing along. So a little bit of weakness on the internals, but again, nothing that would be overly indicative of new money sellers stepping up. I would not be thinking about a big trend reversal here yet. And if we take a look at the NASDAQ through the lens of market profile, I love the repair of the poor high from that Thursday session. If we take a look at the high of the Friday session, though, notice we do not have an excess high. There's a lack of material excess here, and in my view, that would invite price to possibly repair it, and then we have to play the game of responding to price action. Do we accept above that high? If so, we go with. If we quickly repair the structure, come back down almost immediately, we don't go with, right? And that is just a simple putting in an excess high, coming back down into range, probably repairing the structure and trying to auction the market lower beyond that. Notice, though, the difference here between the S&P and the NASDAQ. Clearly, value higher on Thursday, and then value is breakaway and clean on the Friday session as well. So it's not as bearish in terms of a short-term pullback as the ES or the S&P side of the market. With that, let's jump back on over to the platform. Let's finish up our indices with the one, the only. Let's go on over to the Rusty Russell starting with the weekly, and let's acknowledge, of course, a lot of people talking right now about the possibility of a big old, call it a weekly, call it a monthly double top. Let's just put all of those theses on the back burner for now, because what do we know? Here at the Trade Brigade, we have a saying, right? It's not a double top until it is. It's not a head and shoulders until it is. It's not an inverted head and shoulders until it is. It's not a double bottom until it is, which means that if this is going to be an equal high that rejects the market, the question becomes, where do you bring in the lower low? Your neckline would be a break way down here at like 175. If that were to take place, fine. I would agree with you. My goodness, bearish, right? But as of right now, there's so much of an opportunity for just a pullback to maintain itself as a weekly higher low. There's no problem with this. Remember in last week's episode, we were talking quite a lot in detail about this range high acting as the key weekly higher low, and that's still the case at 226s, 225s. If the weekly chart pulls back, what a great spot for a potential higher low. Leaving all of this balance, still content. If you're long, you're feeling like this, right? So we're all set. There's really no issue with that. If we come in here with a Fibonacci from the low up to the high, it's right at the 50% fib now. Over time, it'll align with the 61.8. And then at some point, right, wherever this builds out, and if it breaks out again, we just won't be concerned about this. It'll be the top of this range, right? So all things considered, I think we're okay here on the Russell until this level breaks, at least from a weekly perspective. If we get back down in here, then yeah, of course, the concern will be if we reject the top of the range, then now we have a weekly head and shoulders. Just like we had a weekly head and shoulders down here, or over here, I should say, we're concerned when we break the neckline. I will be concerned when and if we break the neckline. Just like we said in the NASDAQ, just like we said in the S&P, let's not put the cart before the horse. We're not even close. The first thought should be, let's see if this happens first. That's the primary base case, 226, 225. Let's come in with a fib from the low up to the high here, see what we get. 38.2 right here at the low of this pullback, making sense. Let's check in here on our anchored view apps from the weekly point of view. Above the entirety of the stack, we should probably start anchoring some to these pullback lows. Let's just grab the S&P. That'll have some anchors close to these levels. Yeah, look at this. If we just alternate and swap for that, right, here's your 2. That would make sense right around that level. So all set, not really seeing much of a concern from that point of view. The final fib will pull is from this high, and obviously we know the answer here, but it's worth just looking at and reinforcing. If you take this fib 61.8, the more candle closes that we get above it, the higher the likelihood that we get the full 100% retracement. We are well on our way. In terms of candle structure and location, because I will acknowledge I did not start with that here on the Russell weekly, we have a little bit of a different look, which is worth talking about, right? We have much more of an indecisive doji rather than a solid green-bodied bar. We do still yield a higher low and a higher high, but we did close inside of the previous week's range. Now, we know that the Russell small caps are very sensitive to monetary policy, and with the potential for a change here to monetary policy this upcoming week, makes sense to me that the Russell might cool off a little bit. The only other thing that I'll sort of give here to the backdrop is that the rally here has been much stronger in the Russell relative to the S&P and the NASDAQ. I mean, obviously it has not made a new all-time high yet, but relative to its performance, there's actually been a little outperformance from smalls. So with that, we will get on down. I guess we'll just be congruent first. Hang tight. Volume profile. Let's zoom out on this thing. What do we see here? So in terms of this shelf, that could potentially act as weekly consolidation. That would be closer to around 232, and then just reinforcing the top of the range as the top shelf of the volume. All right, so all set, confluence out of those data points. Let's come in here to the daily. Let's get a little bit more granular. Weekly expected move is always going to be up first. We'll take this one in order this time. What do we have? So upper edge is going to be around 244.66. Lower edge is going to be around 232.11s. This is a little bit of a lower low relative to this. Now, we didn't really achieve an hourly downtrend in here, so I would call this a soft daily higher low. We did achieve a little bit of an hourly downtrend here, just noting that we broke out, so it was a higher high, and then we also broke back down here, offering a lower low. So this is really the last firm higher low in the daily trend count. This is soft, and therefore, you kind of have equal low here if you want to just compare the lower edge of the weekly expected move. Upper edge is clearly a higher high, so that's bullish. I'd be a little bit more neutral here on the Russell expectations. Now, the next thing we could talk about is just the inside candle from the Friday session is very different from what we have in the NASDAQ and the S&P. So the failure of the breakout through the multi-day range high to then close back in the range is slightly concerning. Now, are we going to just like short the Russell into the ground? Probably not. I would maintain neutral through here, and then I would start to probably get concerned if we get a break underneath 235.15. That would set the stage for an easier time to break down through this 232. Now, if that happens, you have your Jackson Hole thin structure back here, which would become slightly more compelling to the downside. Now, all of this is in the context of a daily uptrend. We are in a daily uptrend and we're in a weekly uptrend. So if we were to pull back, right, I just want to refocus us for a second on the weekly analysis we just did. Like, we don't do that just for the sake of doing it. We do it to say, all right, if this is going to reverse, and heck, let's just do it. Here's our little speculation. If we do get this and break down here, I mean, there might be some very short-term shorts to take, but just like in the NASDAQ, I wouldn't want to be short into the neckline. I wouldn't really want to be short the small caps into the top end of this range here. And that's going to be closer to that 226.25, top end of the balance, gap fill reversal, all that stuff is there, right? So in the short term, yes, does not look great with the failure back down into this range. There's the possibility of some pullback, right? We're acknowledging the key differences here, but on the higher time scales, not quite willing to throw in the towel yet. Let's take it on down to the hourly chart. We don't need the daily fib there just because it's been a little bit more of a grind through this consolidation. Once again, the sort of small compelling argument for the downside is that the hourly trend is trying to reverse to down, already yielding an hourly lower high. Right? So if this is a lower high and we're not holding a higher low as of the close over 238.50s, then I would think that this is possibly a short trade into early next week, right? Is this a possible idea to exploit risk reward wise? Maybe, right? That is sort of your classic look above and fail, target the opposing end of the balance. That would be here at 235.15. I think the daily chart becomes a little bit more dangerous, as we've already mentioned, if we get something that looks like this. So say that we break down through the lower bound of there, then a lower high underneath 235.15 really sets the stage for the breakdown to retrace the thin structure from Jackson Hole. So that seems a little bit more obvious to me here on the IWM and well within striking distance rather than the full-blown reversals that we've been talking about or speculating on over in the S&P or the NASDAQ, all right? So that is what we have there. I suppose we can just take the weekly fib because why not? We did it in the S&P and the NASDAQ. Let's do it here. You're underneath your fib 38.2. Your 61.8 is in the midpoint of the balance range here. Let's come in from this major low up to the high, just see what we get. Yeah, 61.8 is that line in the sand. It is the bottom end of the balance range there, which kind of aligns and just reinforces that importance. Let's take that off. Let's take a look at the anchored VWAPs intraday. And you'll notice that they're completely clustered inside of the range. So although this might be a trade possibility, risk reward short here, it might not be the cleanest trade to take, right? You're shorting into a major balance range where there's been a lot of chop and slop. You're not shorting through thin structures. So the most attractive short really is like letting this build out and then trying to take advantage of this thin structure retracement if the market's going to reverse more meaningfully. Again, it has to happen first. You have to see it to believe it. But that's kind of the location where I would at least be more willing to try a short given the structure of the chart here. If the market just pops right back up and over 238.50, this entire conversation was for nothing, and we just want to remain bullish. We're in a daily uptrend where we would be trying to reverse the hourly trend back to up at that point, trying to make an equal high. So 238.50, it's a line in the sand on the IWM, all right? Let's jump on into our Russell side of the market internal, see what we have over here. Rinse and repeat everything that was said on the other internals. However, on that Friday session, we actually had a little bit more downside. You're just seeing it reinforced with the internals, given the outflows, the advanced decline line, and the cumulative build. All right, let's get on over to the platform for our market profile. Let's take a look over here. Obviously, value area was actually overlapping to down. This is the first case where we've seen overlapping to down, and the point of control was completely underneath the value area from the Thursday session. Notice that the M period low is a little bit of a spike, so we will have spike rules in play on Monday's open for the Russell. If we open anywhere underneath roughly 2,400, I would say that the bears have a little bit of that edge. That's the equivalent of opening underneath the top end of the balance range here on the IWM at that 238.50 spot. Let's fix this up and take a look at the sectors now for the S&P 500. Let's keep this thing moving along. What do we see? Who was leading, who was losing, and where was the weekly performance? Semiconductors lead the pack, 3.11%, followed by comms, XLK Tech, and the XLU. Interesting. Utilities are slightly more risk off. They're lightweight, but the top three are heavyweight risk on sectors. At the bottom end of the barrel, we see staples, materials, and then XLI was an underperformer there, only up about 30 basis points on the week. Really no concerns. XLP is defensive. XLB is the lightest weight sector. Industrials, yeah, they're kind of middled, right? They're about 8% of the S&P 500. So with that, let's check in on the structural charts and see exactly what's going on here. Are we bullish? Are we bearish? I mean, how could we not be somewhat bullish just in the grand scheme of things on semiconductors as we're making new highs, right? We posted over on X. Sometimes when it's too obvious, right? Everybody and their mothers, brothers, sisters, goldfish, right, was talking about this. When it's too obvious, I'll pop up the tweet right now. It's not going to happen, right? So there you go, right back in the upward direction, brand new all-time high, consolidation up here on the Friday session. Totally susceptible to pullback. Like, this is well within the realm of possibilities. But if you're holding a higher low over 297, can't really be bearish on semiconductors. Just doesn't really make sense. So base case here is still to lean bullish. Communications, brand new all-time high. Base case is to still lean bullish here. Not much to read into. Tech sector, 3-day balance range. If you break down into the gap, maybe it's intra-week pressure for the S&P. But once again, like the SMH, is it really doing anything to change the trend? No, it would try to reinforce the trend via a potential higher low over the gap fill reversal at 265.75. Let's take a look at utilities. Is this outperforming? Is it the one dragging the market to new highs? The answer is no. So we have risk on posture relative to the performance last week, and upward pressure is upward pressure. So I would say, fine, this is actually helpful for the S&P 500. Let's take a look at real estate. Not much to talk about here. Still inside the range. We'll see if rate cuts break that out. Let's move along to financials. Inside bullish 3-bar play into Friday's session. Flat highs across the top. Generally, auction should not end that way. That's a poor mechanical high. We have 54.10 as a possible breakout point. Remember, this is the second heaviest weight sector by market cap. Any sort of consolidation and breakout likely continues to fuel the new highs in the S&P 500. Not bearish there. Let's take a look at energy. I would say neutral inside the balance range. Let's take a look at discretionary. Tesla, huge day on Friday, breaking out in the upward direction here, making a new high. It's bullish. The all-time high is right there. Pullbacks over 234 look fine. If we look at this level right in the daily 20, perfect support there on Wednesday. Then the big follow through into the end of the week. The trend is up. Really not overly concerned about this until we start producing either lower lows or failing to go higher over the all-time high. Let's just say that we test, fail with a big upper wick, test, fail with a big upper wick. If we get something that looks like that, fine. We'll start to say, okay, maybe a pullback is probable. But as of right now, really can't change tone to bearish in nearly any of these charts. TLT, the bond market, clearly moving higher as rates move slightly lower in anticipation of the rate cut. We'll see what happens with them on that Wednesday session. XLV, failed breakout here. This is one that we could read into a little bit. This is no longer the second heaviest weight sector. It's not even the third heaviest weight sector. It's the fifth heaviest weight sector these days. So look above and fail. It's not all that concerning in terms of, again, weight for the S&P 500, but it is notable, right? Failing to break out of a multi-month balance range here, and then even just this as a tighter balance range, rejecting the daily 200 SMA, it's probably worth keeping tabs on. If this starts to roll over to the downside, you will just want to see that continued outperformance from some of the other sectors if the S&P is going to continue to make new highs. Now, in terms of healthcare as a defensive posture, if it breaks down, I'm also not ducking and covering under my desk and saying, oh my God, a recession's here when defensives are outperforming. I mean, if it's underperforming, then it just is what it is. It continues the bull thesis, really, for the posture and the risk appetite over in equities for the S&P. If we look at industrials, there's actually a number of industrials charts that are setting up really well, much, much better than the sector level chart, but there's nothing to talk about in the midpoint of this range. Let's talk about staples. Not much going on here. It continues to hold 80, which still looks bullish in my view, and XLB is just knocking on the door. You could probably start to draw in ascending triangle, whatever you prefer, but all these equal highs at 92.70. If it breaks out, that will certainly help fuel the market in the upward direction a little bit. Remember, this is the lightest weight sector that we have. Let's jump on over to our ratio grid and see what's happening over here. If you're not familiar with how to set up ratios in Thinkorswim, check out the video tutorial in the top right-hand corner. This has improved dramatically off of this low, making a new higher high, trying to recapture the daily 50 SMA. I'm back to being a little bit more bullish and optimistic about the tech relative performance. XLF, unfortunately, looks horrible still on its relative performance, but the structural chart still looks fine. So based on the push and pull between these two, I'd probably just neutral out to exactly that, neutral. We have bullish activity here, we have bullish activity here. So if we're 3 for 4 bullish and 1 neutral, probably still leans risk on. There is no sign of a flight to safety or risk off in these sectors right here. If we check in on the AB sets, you could see that we are batting 5 for 5 basically. The reason I would say that is because of the recovery here over the 50 SMA. It's still technically trying to point and curl up, we're looking pretty solid in terms of risk appetite for the market. Markets definitely lean a bit more risk on here as we're making new highs. If we look at the B set, the gold ratio has slowed down ever since that labor report. Even with the inflation reports, it really hasn't done a whole heck of a lot here. Gold is kind of neutralizing, if you will. We do see that the TLT is rolling back over here in terms of its ratio. And then if we zoom in on Bitcoin, I actually want to go to a full screen Bitcoin chart for just a second like this. There's been a big recovery. I think what we could do is there we go. Let's get this configured properly. So ignore this study down below, although the daily is firing a bullish print. It's really developed for the weekly. Bitcoin is cleanly back over that 113,850. I mean, Tesla had so much of my focus on Friday. Wasn't even really watching Bitcoin, but the fact that this was or is over that neckline now probably bodes well for risk appetite. You have to think of Bitcoin right now as being, more of a risk instrument. If you look at Ethereum, nice breakout over 4,500 as well. These equal highs from there. It's probably worth keeping tabs on crypto to see if we can get any sort of swing trades that start to develop. But in terms of data points for the market, probably leans more risk on rather than risk off. If we're looking at the dollar, it's pretty flat down here. It hasn't done much. One thing that's interesting out of 10-year rate is that 4 might be the floor. 4 might be the floor. If this breakdown is pricing in all of the concern that the market has right now with the labor situation, you might not be able to go much deeper than that, right? And one prospect here is to just sort of understand the spread between rates right now and the 10-2 curve. Even you could use the 10-3 month, right? Typically, right, you're going to have 2 points on top of the Fed funds futures rate. And if you think that the Fed fund futures are maybe going to like 3%, we're currently at 4%, right? Then it just wouldn't really make much sense for the TNX to go much lower than that, right? 4. As a matter of fact, it would seem as though it might even bounce off of 4%. Now, we shall see. And again, I think that the labor situation is starting to overpower what we're having or seeing going on in the inflation story. So let's take a look over at the inverted ZT. We'll get a little bit deeper into this. This is pricing in, of course, our cut that's nearly in the bag right now. Let's go take a look at the Fed Watch tool. If you just jump into the table, you can see that it's not a question of is it going to be a cut or not. Is it going to be 25 basis points to here or 50 basis points to here? Personally, I think that the 25 and then another 25 is the most likely outcome as the market's pricing in. A surprise cut, in my view, would start to signal from the Fed that they're much more concerned about something having broken, and therefore something that you might use on the Wednesday session is if the Fed surprises and goes with a 50 basis point cut instead of the 25 basis point anticipated cut, then we would be a little bit more concerned about the potential for downside in the market, because why is the Fed basically signaling, hey, something is not going well here, right? If you're like, what are you talking about, Fed and all that? It's the FOMC. It happens, 10 times? They skip 2 meetings, or is it 4 meetings? 8 times? It's one or the other. Don't hold me to it. But the Fed meets, right? They decide what should happen with short-term rates, and we get the announcement on usually Wednesdays at 2 p.m. Here we go. So Wednesday, September 17th, make sure you're aware of what's going on. If you're like blind to the risks going into this, if you have full positions on and you're just like swing trade or day trading willy-nilly around 2:30, and you're blindsided by the volatility, then that's no one's fault but your own. You need to be aware of these things. So I think the most telling part is, again, what the Fed does, 25 versus 50 basis points of cut. And then also, what does the SEP start to outline for us? If we look at the last SEP, first thing that we should point out is the dot plot, right? This shows us where Fed members are voting, because remember, it's not just like one person sets the rate. They all vote, and the consensus view is where policy ultimately goes. You could see last time that a number of participants were actually like, no, we think rates should be higher for longer. This is kind of where we are at right now. If the dot plot shifts materially lower, that would tell us that the Fed is likely concerned about the labor situation more so than inflation, and they would also spell that out. So I guess before we get down to those risks, what we would just say about this is there was a pretty split Fed last time, right? You could see that there's a difference between where 2 clusters of groups were at. Does this converge around one particular point, or is there still a big split in the Fed, is a key question to ask and answer from the dot plot on Wednesday. As we scroll down, we want to look at the distribution of risks to unemployment. This is GDP, which we don't really care about. This is the dual mandate. So risks to the unemployment rate, as the Fed saw them on the last meeting, remember this is June's projections, they weighted them to the upside, right? A small little downtick here and a small little uptick here. So weighted to the upside, risks to unemployment. However, if you look at inflation risks, they did the same thing. A little bit of downside, a little bit of upside. Here you go. You're still seeing a weighted upside risk to inflation. So we didn't really get any information from the Fed last time about which part of the dual mandate was really more appropriate to focus on. I have to imagine, and I don't know, maybe this is too much speculation from my part, but let me know in the comments if you agree, I have to imagine that the Fed reduces this risks of upside inflation. And, even if this starts to balance out, say that these two columns become equal, right? Something that looks like that. And then if we go back to unemployment, this should probably go to here, and this should probably stay like this, right? That would be what I would expect from the Fed, and we'll see what actually happens. I'm not going to put positions on hoping for that or looking for this. We will be looking at the data. We'll probably actually stream it live here on YouTube on Wednesday at 2 o'clock. So if you're interested in this type of stuff in the Fed analysis, make sure to come back out to the channel on Wednesday, 2 o'clock. We'll stream the FOMC. With that Fed speak sort of concluded, the other calendar items that we should probably pay attention to are few and far between. Core retail sales Tuesday morning, probably not going to move the needle. Everybody's focus will be on Wednesday, 2 o'clock for the FOMC earnings calendar. Not much going on here. Cracker Barrel, sticking with the original logo apparently. Bullish is a brand new IPO. We'll see how they report. That's really it. FedEx typically has some good insights in terms of the economy. Maybe they'll have a little nugget of truth for us to parse out of the report, but for now, pretty quiet on the earnings front. So let's get back over to the platform here. Let's finish our broad market analysis. You'll see here, this ratio chart is different durations of bonds, right? So what we've been talking about is that this elevated rate down here, this elevated chart ratio, was indicating that the market was still fairly concerned on the long end about inflation. The fact that this has deteriorated so rapidly is why I would expect that in the S&P, we see a shift to the risks focused more so on the unemployment rate rather than inflation. If the market was more concerned about inflation, this would still be elevated. And if the market was still concerned equally so as to the unemployment rate, then this would still be plummeting off of a cliff. The fact that this has reversed is the tell, in my view, that the market is less concerned about inflation now, but we shall see. Let's jump on into the credit spreads. These are rotating in the downward direction, which is healthy for risk appetite. So as we're thinking about these additional data points, remember back to the question we asked in the intro. Does the data support a crash and burn look, or does it support, no, if a pullback happens, fine, underpinnings are still bullish. I would certainly side with the latter, right? If we're looking at junk bonds and corporate grade, new highs over here, not as meaningful of a new high out of the junk bonds, but still a new high nonetheless. That aligns with. There is no bearish divergence. We talked Bitcoin already. Let's look at breadth. Breadth small rollover into the Friday session. This would align with what we saw in the market internals. Just the fact that we didn't get that big bullish follow through when we made new highs over in the S&P, but we closed back inside of Thursday's range anyways. So this kind of makes sense in my view. It's not really a surprise, noting what we've already talked about. RSP would show you something very similar. It never broke out over the Thursday high, so a little bit of a breadth divergence there. QQQE also is not even close to its all-time high, and it's not even really breaking out through this range high. I'd be a little concerned about that breadth, but not enough so where I would say let's short the market, it's got to crash and burn. Just looks like a little bit of a lag right now. If we're looking at VIX, VIX is low. I would expect this to ramp up ahead of the FOMC. VVIX probably does the same. See how it's not quite making that equal low? I would expect this to remain elevated. Heck, I wouldn't even be surprised if, Tuesday late day, maybe even Wednesday morning, we get up and over 103. The big tell will just be watching the VIX one day and seeing whether or not this ramps really high into Wednesday. Let's say at like Wednesday, 1 o'clock, you're getting a 21 print out of the VIX one day. As soon as Jerome Powell starts speaking, this is going to collapse and you'll just get a mechanical rally in the S&P 500. That's really what's taken place through all of or most of, I should say, the previous reports that have come out on the economic front. If we're thinking, though, about the posture of the term structure in volatility, I mean, we're still in really deep contangos here. We're not even close to backwardation on the near-term contracts. I mean, if this were to flip under the zero line, I'd be like screaming from the rooftops, oh my God, the market's pricing in an absolute catastrophe. It's just not the case, right? So you might take the counter argument and just say, okay, if nobody's expecting it, that's probably when it's the worst. You might have something to stand on there, but I would be more concerned about that if the S&P daily and weekly charts were neutral, threatening the possibility of a trend change to down. If we had complacency with that situation, much different story, but we just don't. Let's take a look over at the core list of companies. Let's get the job done here for the end of today's episode. And then I've got, again, those 5 trade ideas, and I'll send you on your way. NVIDIA's daily chart is just stuck in a 3-day balance range. I think this is a very easy watch. You're just going to sort of look for a move into the gap, in which case this as an inverted head and shoulders. Watch your gap fill reversal for a neckline support. If you do get a daily high or low there, maybe this starts to rise from the ashes, but I would still just be neutral really on NVIDIA. I don't have an overwhelmingly bullish stance on NVIDIA. It's neutral, noting the rejection of 179 cleanly from the bottom end of this range back here. As long as we're under 179, can't really get aggressively bullish. If we do get acceptance here, there's a thin structure retracement over 180.85 from the earnings bar. If we just take a look there, that's just nothing but upper wick, right? Not nothing but net, but something that looks like this, and then this, all set 180.85 bullish Brigade bolts over the level into 183.75. There you have it from NVIDIA. And again, just a balance range until proven otherwise. I wouldn't really touch it inside of this range. Let's take a look at Microsoft. Interesting news, of course, with the whole OpenAI deal, but it was still unable to break out over that 511.25 spot. That, to me, is still the top focus for Microsoft. If this is going to be a little bit of a rounded bottom and it's going to get in gear and play nice, with the tech cohort and really push markets higher, there's some room to run back in the upward direction, don't get me wrong, but the trade here is probably the first thin structure retracement outside of the range, right? If this is the range, nice consolidation Friday afternoon, but got to see acceptance over that 511.25 for this thin structure retrace back there. 518.50 is the primary target. If it's just chopping around in this range below, not really, Microsoft has been a very poor trader inside of this range until the catalyst actually hits. So if you see more about the catalyst, if you see more about OpenAI into the weekend, maybe it's worth a watch over this, but if it just fades off to the middle and there's nothing going on with it, I would kind of just stay away. Let's take a look at Apple, and that's, from a trading perspective, of course. If we look at Apple on the daily, I think that this is much more of a reasonable place to start speculating in terms of, is it possible that you get a rejection here at 234.25 and offer a bit of a head and shoulders? I mean, that seems like a more reasonable outcome, noting that we're already at the place where that right shoulder could form. So if this is an equal low now on the Apple daily, could we get a lower high at 234.25? I think it's within reason. If we go down to the hourly chart here, you could see what has gone straight down, came straight up. If this rejects, I think that this is the first trade, certainly a thin structure retracement there. A breakdown through the high and tight consolidation lows from Friday offers you practically nothing. You might want to be a little bit more cautious until there's a lower high under the daily 20. That's fine. But generally, underneath 233.20, you could look for 229. And if that's the case, this will then look like a daily lower high. Then, of course, the concern steps in underneath the neckline. Then there's really nothing, right? There's really nothing. You've got the two key moving averages at 220, but then you're talking full gap close, and you're probably talking all the way back down towards 205s. I think that's a little bit aggressive to speculate on as of right now, but the possibility of a lower high here, much, much more reasonable. Now, if Apple accepts above and the momentum continues, then fine. Maybe you avoid that and you just build out the start of an ascending triangle. And then it requires the next catalyst, because Apple has traded horrifically these days without a catalyst. If you get something over this, then fine. 240 continues the uptrend. Let's take a look at Amazon. Kind of a nutty chart here. Failing the weekly breakout level, which would have been over these pivot highs back here. Aggressive coming back in, but now perfect gap fill reversal on that Friday session right off of the highs of this prior bar over here at 226.45. If we take a look at the hourly time scale, what you'll see is that the hourly trend can easily continue in the downward direction via a lower high underneath the equal lows here. That's 229.50s. If we do get something that looks like this, though, I would start thinking about the inverted Man Ray pattern, right? Which is a double bottom attached to, inverted head and shoulders, whatever. This becomes the more compelling structure to the upside over 231.40, right? If we could get that, that would be interesting. Now, if this just does this, then fine. You don't have the Man Ray. You just have a simple inverted head and shoulders. It would require broad market strength for me to want to get on board here, noting once again that this is a weekly failed breakout. If we just go here to the daily and reset this to a weekly chart, notice that you looked over these highs, basically rejected the all-time high for all intents and purposes, close enough on the weekly chart, right? Rejected there, and you're back inside of the balance range. So just like on the NASDAQ, we want to avoid look above and fail. You already have the look above and fail on the Amazon weekly. Okay, so not the greatest looking chart there. Let's go back to a daily. And those are sort of the outcomes I would look for. Like rally rejections of 229.50 really set the stage for continued failed breakouts. And I mean, hypothetically, if this is a daily range as well, look above and fail, right, should target the bottom end, 220.50. We'll see. I don't really like if the broad market starts to slow down a little bit, maybe it makes sense to be bearish Amazon here, but like these short trades aren't even the main focus of the market right now. It's really, being selective in your setups and trying to pick the names that have the relative strength and trading those. So we'll see, but that is Amazon. I do like the daily wick off of the daily 50 SMA. So maybe that counter trend move is what we look for first, and then we'll evaluate on this level test at 229.50. Let's go on over to Google. Just an absolute monster into blue sky territories. Let's go up to the daily chart. Getting a little bit wicky up here, a little bit indecisive. I don't think it's enough to short Google, but if you can break over these 3-day highs, blue sky territories over 242. If you go down to the hourly chart again, what you'll notice is if this is going to turn into head and shoulders, there you go, 238. If you break below that, you have thin structure retracement probably coming back down to this level, and then 230.75 is the major daily level coming from the top end of the gap up session from back here when they apparently, did they win the case or were they just granted approval for, not having to break up. We'll don't get too nitpicky about the wording there. But anyways, that's Google. Your key levels 242, 238, 230.75. Let's jump into the metaverse. This is an awful chart. I've stayed far, far away from this these days. Not much going on here, not much going on here. It's just all over the place. Could it try to build out a higher low? It might be trying that, but I just don't love trading back into these highs, which then there's highs here, then there's the gap. It really needs to prove something much more clean on the daily before I'm interested. Here's Tesla. What an absolute monster on that Friday session. Felt like it was chasing, but, just a clean breakout through the top end of the weekly level, over the daily level. A lot of things going on there. So I know a lot of people made money on Tesla on Friday. Congratulations to everybody who participated. What's next for it? If it pulls back, I'd ideally like to see higher low holds over 380. Of course, a lot of people talking about the possibility of just closing the gap to 400. We'll see what happens with that. If you go out to the daily chart and just zoom out, though, so you could look at this, you do have these prior major highs to contend with before it's like, all-time highs on the radar. What I would really focus on, again, is that 379.75, 380. Do these previous lows support now as support again? One of the things that could have happened on Friday, right? You could debate me on this or not, but it could have been a rally rejection of 380, which would have failed the breakout, right? So now the key component is just staying above that level, right? So to me, that is the major level to watch at 379.75. Do we support above or not, right? So I think the base case would be yes, considering the momentum and just the sheer amount of volume and eyeballs on Tesla, and you would just learn a heck of a lot of information if you failed that. If you're back underneath 380, oh my God, anybody who's long late to the party on Friday and still holding, suddenly massive face of disappointment. I think the better trade to watch for, if that ends up being the case, is the deeper pullback here to retest the top end of the weekly range. Now you're talking about daily Brigade Bolt over the sort of first breakout level from the Thursday end of day, right, at 365. So that to me is how I'll be watching Tesla. I suppose to boil it down into its simplest numbers and the pivots, 379.75. 365 if we're underneath that big daily pivot. If we're over 380, right, then we're pretty much looking for any bull flag consolidation and continuation into those daily pivots above. First gap close $400, then we're looking at 418, 438.75. Tesla will be a top watch, just noting it's got all eyes on it, momentum, the whole 9 yards, right? JP Morgan, how are we doing over here? Looks pretty good into blue sky territories. A little bit of a fake out, not going to lie, on that session. What was it back over here? That would have been on the 8th, right? So little fake out back below this 294.80, but so far, full 100% retracement, plenty of room for a higher low and continuation. We know the XLF is knocking on the door of its daily breakout level. If we get something that continues here in JP Morgan, probably going to fuel the fire for, once again, S&P continuing in the upward direction. Moving along to Palantir, lovely looking chart also, breaking out of a balance range, classic Brigade Bolt here. I do think that we want to pay attention to this level at 171.25, origin of the breakdown, also the gap up lows. If we take it on down to the hourly chart, you could start to see how if we get this, okay, now we're talking. A hold here, it's probably worth trying longs at 167.85, target the equal high. Then if we can get over the equal high, 171.25, looking for just some of these smaller inflection points, there's really not much. I'd say the next real important spot is just going to be this 183.85, 183.50, not 85, excuse me, because it contains the overhead supply. But on the way down there wasn't a whole heck of a lot of structure. So 171.25 will be the main pivot watch. Once again, holds of 167.85 look pretty good. This Brigade Bolt to upside, clear this zone, and you're really looking at 183.50. If you're under 167.85, I'd be kind of neutral through here. And then if we fail back down into the range, now you have a head and shoulders on the hourly and you're back in the range. Probably target the low end at 152.50. We are not there yet. We can't speculate on that as of right now. This is the highest high in the hourly trend count. Let's take it on over to Broadcom. Another one that's just like, it's bullish until proven otherwise. A little bit of a failure to go higher in the upper wick from Thursday, but not enough for me to really be short this stock. Consolidation through here, then Brigade Bolts back to blue sky territories. Looks pretty darn good. If we get something that looks like this, I don't really even think I would short that, if I'm being honest with you, and I would wait patiently to see if we're in here. That's really the only short in my view, through the thin structure on the gap. That's under 331.30, targets 308.85 technically, but I would give respect to this previous all-time high at 317.25. Hourly chart, not really going to glean a whole lot from here. If this is descending triangle, if it's, you could call it double top neckline with a lower high, It's clear that that's maybe what sets it up, but I wouldn't front run the idea over 356.25. Next up, AMD. What an interesting stock recently. It's almost like it's back to being the advanced money destroyer. What I think about this is quite a bit about this 158.50, right? Being underneath that. This to me looks like a lower high rejection of the daily 20, daily 50. The more time this spends under 158.50, the more pressure I think is on it to continue in the downward direction. I mean, Broadcom, even MU these last couple of days is totally blowing AMD out of the water. If this is going to be inverted head and shoulders, if it is going to reverse the curse and it's no longer going to be the advanced money destroyer, you got to show me something like this. That's first of all avoiding the lower high underneath these prior lows at 158. Could not really do that into the close on Friday. Little intraday rally, but failed back below. But step one is get back above the level. Step two is show me the Brigade bolt over 163.65, where it's just not really seeming like a high probability outcome given the way that the market acted there on Friday. So instead, I would say the higher, likelihood thing is to watch for consolidation here, and then just simple Brigade bolts underneath the low of Thursday at 155.40 targets the gap down below 150.50 and then 147.60. That is AMD in a nutshell. And again, we have daily highs, lower highs, lower highs. Lows, lower lows, lower lows. Even if you just want to call all of these equal lows, 1, 2, and 3, undoubtedly a lower low happening here, attempting to get into this gap once before. Let's jump into Robinhood and see what's going on with Hood. A little bit of a failure over the all-time high, I'll give it that. However, it's got to break the Man Ray neckline. Here you go, right? Here it is on the hourly. Show me the break of 114. Maybe it's thin structure retracement. Maybe we start looking into the gap here, but it's got to do it. Got to see it to believe it. I think the ingredients are there. Now it's just a matter of does it break. So 114 is a top watch on Robinhood. If it actually does something that looks like this, lo and behold, you will have a double bottom over the neckline at 117.25. Probably targets this high here at 120.85, and then the all-time high beyond that, blue sky territories, rock and roll. Nothing that Vlad can't do for us. We shall see. But Robinhood, first thought, given the failure of this level, consolidation, Brigade bolt here. I'd say if the broad market pulls back, Robinhood would be one of these opportunities that you likely want to look short on rather than some of the other ones where we're like, we're probably still leaning bullish here. AMD leans a little bit short. Robinhood here leans a little bit short. Apple possibly a little bit short. Microsoft neutral. NVIDIA, maybe if it's into the gap. Palantir long. Tesla long, right? Google, right? Probably more on the long side for Google. And that's that. Those are the core list of companies. We have 5 additional ideas for you. TSM is the first one. Let's stay on the topic of semiconductors. Just an absolute monster breaking out through these range highs. And you can see a 3-day balance range forming. If this cracks the lows, I think firstly a gap close. But then beyond that, right, you're just looking at this as a classic Brigade bolt. If you could get the retest over these prior highs at 247.85, it's a top opportunity that I think a lot of people will be watching for. So TSM, interested in that. It's short to get there underneath the lows of the 3-day range. If you just consolidate up here, then you can't really short it. You got to go with under those circumstances. That's TSM. Keep it simple. CRWV, CRWV. CoreWeave will be a top watch early in the week, just noting that here's your double bottom, here's the neckline, and you got a perfect response off of that on Friday. Again, a lot of focus. It's almost like there's been so many setups in the market right now that it's hard, you're not going to catch all of them. First of all, you got to focus on those top priorities for you and the ones that you can execute on. So CoreWeave is like probably second tier to Tesla, I would say. But if we need something, let's say Tesla fizzles out and nobody's interested in Tesla anymore, CoreWeave, double bottom neckline retest, hammer high over the 50, probably looking at an equal high target up here towards that 122.85. Let's take a look in the hourly chart, right? Clean V-shaped response off the gap fill. It was actually a very clean gap fill to that high. So holding the neckline, it just makes sense here. If we're over, I would say this level, 114, over 114 probably starts to trigger the possibility of upside, being the break of the daily hammer high, basically. A recovery over the daily 50 as well. You could look for the Brigade bolt, hourly higher low above that, 5-minute, 15-minute higher lows above 114. Then the target again is in here at 122.85. That's CoreWeave, second idea that we've got for you there. Not interested if it just stays in here and dribbles back below 106.25, off radar. That's CoreWeave. Let's move into IONQ. This was an idea we had with the group on the Thursday night headed into Friday. And again, Tesla probably overshadows this as an opportunity. However, just an absolutely monster outsized move over this 48.35. If this pulls back, anything that's supportive over that probably gets continuation. Or if you open high and tight, let's look at the consolidation from Friday afternoon. If you open high and tight in this range, you could probably throw a level on here at 53.80s. If you're over that headed into Monday's open and you're holding, any sort of break through that Friday high, likely, as long as volume is there, definitely pay attention to volume on these names that have sort of parabolic runs going on. If relative volume, so our vol, in the overnight session headed into Monday morning is elevated. You're in the range. Any breaks over this high likely gets it going. You could just put a stop right underneath the low of day or something underneath that 55.80 previous day's high. So that is IONQ. Very, very interesting setup here, breaking out of a multi-month, almost a full year's worth of consolidation. Call it cup and handle, call it whatever you want. Big breakout here over 48.35. Definitely worth having on your radar if you're into that type of thing. TEM, Tempest. This one has not broken out yet, but you can see the alert over 92. Bullish 3-bar play here on the daily. Little inside consolidation from Friday. Notice how if you do this over that previous wick, as long as we're above that, and we'll probably just refine this on the hourly chart right now. Let's take a look at what the number is. Should technically be right around in here. Let's get that off. Here we go. I'd say 55, 84.55s, as long as we're above that on Tempest. Looking good in terms of a mild pullback. Call it a bull flag over the level. And then, it's either over 91.50s or break the flag over the trend line, right? Either of those two situations probably play just fine in terms of the way that we look for this on TEM. Not interested if you fail underneath 84.50, at least in terms of a momentum break. You want to see the volume come back into this as well, just like we talked about on IONQ. Let's talk about CAT, final trade idea. It just looks good, and it's outside of the sphere of influence from the whole tech theme right now. So if tech cools off, if the QQQ pulls back, if the market freaks out a little bit on the rate cuts, maybe this as a double bottom, call it an ascending triangle. You could call it a bull flag on the weekly. If you break over that, you're into blue sky territories over this 436.65. Can we get consolidation here? And then a Brigade bull into blue sky territories is the question. And once again, not related to the tech side of things right now. So a little bit, I don't want to say immune, but it will likely just trade differently than what you have fueling, the core list of companies and even the trade ideas we've outlined so far, focused on semis, tech, AI, quantum as a theme as well. If you look on the hourly chart, you could maybe add this level in here as well, around 440.25. If you get a little hang up there, you might want to be a little cautious. So it could be clearance of that level to get involved. But once again, any consolidation in this range, Brigade bolts here, rock and roll over 440.25. That is what I've got for you in today's episode of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we'll be live every morning. We are live every morning, 8 o'clock Eastern time for episodes of the pre-market prep hosted free live here right on the channel on YouTube. So come check us out. If you've not been tuning into those, feel free to tune in. It's always a great time. We will be live on Wednesday as well for the full playing out of the FOMC. We'll probably start at something like 1:45. Once again, have yourself an awesome weekend. Have yourself a green trading week upcoming. And as always, I will see you in the next one.